Thursday, January 29th, 2026. Silver hits $120.21 per ounce. Not $120 even, $120.21. That extra 21 cents matters because it represents the exact moment the market peaked before physics took over. By Friday night, silver had collapsed to $78.53. In less than 24 hours, the most profitable asset in the world became one of the fastest liquidations in commodity history. Here's the question nobody wants to ask. If silver was truly at a supply squeeze, if industrial demand was overwhelming physical availability, if China's export ban was creating genuine scarcity, how does the price fall 37% overnight? The answer is uncomfortable. It doesn't. Real shortages don't evaporate because of a rumor. Physical scarcity doesn't vanish when treasury yields tick up. What happened to silver this week wasn't a market judgment on value. It was a balance sheet event. And the difference between those two things is what actually matters next. Let me be precise about the stakes here, because this isn't abstract. When silver went from $120 to $78 in a single session, $70.52 million in leveraged positions were liquidated in a 4-hour window. 99% of those were long positions, people betting the price would rise. These weren't hedge funds with deep pockets. These were retail traders, the silver squeezers who believed they'd found the next GameStop, and institutional whales riding momentum. One trader on the hyperliquid exchange was liquidated for $18.13 million. That's not a rounding error. That's a wipeout. But here's why this matters beyond silver. The iShares Silver Trust, ticker SLV, fell 28% in a single day. Gold, the supposed safe haven, drops 9% to 11%, falling from around $5,600 per ounce to roughly $4,900. When even the hedges start behaving like speculative trades, when assets sold as protection against chaos become sources of chaos themselves, that's not just volatility. That's a sign the system is under stress. And it's not just traders, industrial buyers, companies building solar panels, AI infrastructure. The actual consumers of physical silver experienced what the research calls a liquidity trap. They couldn't secure metal at any predictable price. One day they're looking at $120 per ounce. The next day it's $78. But good luck actually executing a purchase when the order books are in free fall. For manufacturers operating on thin margins, that kind of whipsaw isn't opportunity. It's paralysis. To understand how we got here, you have to go back to January 1st, 2026. That's when China implemented strict export licensing on silver. Not a full ban, but close enough. The stated reason, protecting domestic tech and green energy sectors. The real reason, leverage. China understood that silver had become critical infrastructure for AI chips and solar production. And by controlling exports, they controlled supply in Western markets. Spot premiums, the extra cost to buy physical silver over the paper contract price, hit record levels almost immediately. By mid-January, the silver squeeze narrative had gone mainstream. The pitch was seductive. Silver is in structural deficit. Industrial demand exceeds 120 million ounces annually. China just cut off supply, and the gold-to-silver ratio, historically around 80-1, had compressed all the way to 50-1. In English, silver was surging relative to gold faster than it had in decades. Retail investors piled into silver-backed ETFs like PSLV and SLV. Whales took leveraged positions on futures. Then came Friday morning. President Trump nominated Kevin Warsh as Federal Reserve Chair. Warsh is a known hawk, someone who favors higher interest rates to control inflation, even at the cost of economic growth. Markets understood immediately. The era of cheap money was ending. The Bloomberg Dollar Spot Index jumped 0.4%. 10-year Treasury yields spiked. And here's the mechanism that matters. When the dollar strengthens and yields rise, non-yielding assets like silver become instantly less attractive. You can't earn interest on a bar of silver. You can earn interest on a treasury bond. Capital flows accordingly. But that's just the spark. The real accelerant came from the CME Group, the exchange that runs COMEX, where silver futures trade. On Tuesday, January 28th, they'd already raised margin requirements once. Then, as prices went parabolic on Thursday, they announced another hike, 36%, effective Monday, February 2nd. Let me explain what that means in practice. Margin is the collateral you post to trade futures. If you're holding 5,000 ounces of silver on leverage, and the exchange suddenly says you need 36% more cash in your account to keep that position open, you have two choices: wire the money immediately or get liquidated. And when prices are falling at the same time margins are rising, the math turns savage. You're losing money on the position and being asked for more capital simultaneously. For most traders, there's only one option: sell immediately. That's when the algorithms kicked in. According to the research, an unclear Reuters report surfaced suggesting the end of U.S. strategic metal support. Whether the report was accurate, a leak, or a miscommunication doesn't actually matter. What matters is that algorithmic trading systems are programmed to front-run news. They don't analyze context. They scan headlines, detect keywords like strategic metal and end of support, and execute sell orders in microseconds. The research describes it as a slaughterhouse effect in the order books. Human traders couldn't react fast enough. By the time people understood what was happening, the cascade was already underway. Here's what's supposed to happen in a functioning market. Supply and demand set prices. If there's a genuine shortage, say China cuts exports and industrial buyers can't get enough silver, prices rise until demand falls or new supply enters the market. Here's what actually happens when leverage enters the picture. Prices become a function of financing, not fundamentals. Silver didn't fall from $120 to $78 because solar panel manufacturers suddenly decided they didn't need the metal anymore. It fell because traders couldn't meet margin calls. Those are very different mechanisms, and confusing them leads to catastrophic misunderstandings. Let me break down the leverage trap step by step. Silver enters 2026 already hot. It gained 150% in 2025, outperforming gold, driven by real industrial demand, solar installations, AI chip production, infrastructure. That momentum attracts momentum traders. They're not buying silver because they believe in the fundamentals. They're buying because the chart is going up and to the right. Many of them are using leverage, borrowing money to amplify their bets. As prices climb, more traders pile in, pushing prices higher, which attracts even more traders. This is the reflexive loop that defines bubbles, but it only works as long as financing remains cheap and stable. The moment borrowing costs rise or collateral requirements increase, the loop reverses. Traders can't roll their positions. They're forced to sell. And because everyone is leveraged in the same direction, long silver, everyone tries to exit simultaneously. Now add the margin hike. The CME raised maintenance margins by 36%. That's not punitive, it's mathematical. When volatility spikes, the exchange's clearinghouse, the entity that guarantees every trade, faces potential losses if traders default. So they require more collateral. It's risk management, not manipulation, at least mechanically. But the timing is lethal. You're raising margin requirements precisely when traders are least able to meet them, because their positions are already losing value. Then you layer in the algorithmic selling. Modern markets aren't just humans making decisions. A huge percentage of trading volume comes from machines executing pre-programmed strategies. When a Reuters headline, accurate or not, suggests policy shifts, those algorithms don't pause to verify. They sell. And when they sell, they trigger stop-loss orders from human traders, which trigger more algorithmic selling, which creates the cascade. This is why what happened to silver wasn't a verdict on its value. It was a liquidity event. The price didn't fall because silver became less useful or less scarce. It fell because the people holding leveraged positions ran out of money to maintain those positions. Conviction disappears when financing does. That's not cynicism. Here's what I think is really happening and why it matters beyond silver. This wasn't a market correcting a mispriced asset. This was forced liquidation, revealing how fragile speculative structures become when liquidity tightens. And the warning sign isn't that silver fell. It's that assets positioned as hedges, as protection, as stores of value, behaved exactly like high-beta speculative trades. Think about what we're told about precious metals. They're supposed to be safe havens. They're supposed to hold value when paper currencies falter, when inflation runs hot, when geopolitical uncertainty spikes. Gold fell 11%. Silver fell 37%. The SLV ETF, a vehicle specifically designed to track physical silver, dropped 28% in a single session. If these are hedges, what exactly are they hedging? The answer is, they're only hedges when liquidity is abundant. The moment credit tightens, the moment margin requirements rise, the moment algorithms start front-running headlines, everything becomes a source of cash to meet obligations elsewhere. This is what happened in March 2020 when COVID hit. Gold initially fell because funds needed to raise cash for margin calls in other positions. It didn't matter that gold was supposed to rise during crises. What mattered was that it was liquid enough to sell quickly. Now connect this to the Kevin Warsh nomination. Markets understood immediately that Warsh represents a shift toward tighter monetary policy. Higher rates, stronger dollar, less liquidity. That's the Warsh shock the research describes. And it's not just about one commodity. When the Fed tightens, when the dollar strengthens, when Treasury yields rise, capital flows out of non-yielding assets across the board. Silver was just the most over-leveraged, the most exposed, the first to break. But here's the part that should concern people. If this kind of liquidation can happen to silver, an asset with genuine industrial demand, real supply constraints, and a compelling fundamental narrative, what happens to assets that don't even have those things? What happens to cryptocurrencies trading at 100 times leverage? What happens to meme stocks, to SPACs, to all the speculative froth that accumulated during years of zero interest rates? I don't know the answer, and anyone claiming certainty is selling something. But I do know this. When conviction evaporates the moment financing tightens, you're not looking at investors with thesis-driven positions. You're looking at traders chasing momentum with borrowed money. And when the leverage unwinds, it doesn't matter how compelling the story was. The margin call doesn't care about your thesis. Now, there's a counter-argument I need to address fairly because it's not frivolous. The manipulation argument. Critics, particularly in the precious metals community, argue that the CME and large banks like JP Morgan coordinate margin hikes specifically to save the shorts when silver enters a parabolic move. They point to the Hunt brothers in 1980 as precedent. Two billionaire brothers tried to corner the silver market, driving prices to $50 per ounce, and the exchange responded by changing the rules mid-game. They restricted new purchases, raised margins, and the price collapsed. The Hunt brothers lost billions. The parallel to today is obvious. Silver hits $120 on Thursday. By Friday, the CME announces a 36% margin hike. By Friday night, silver is at $78. The timing looks suspect. If you're a retail trader who just got liquidated, risk management sounds like a euphemism for rigging the game, and the frustration is understandable. Rules shouldn't change in the middle of a trade. If you entered a position under one set of margin requirements, having those requirements spike mid-trade feels like moving the goalposts. Here's what that argument gets right. Margin hikes do disproportionately hurt the leveraged longs. If you're short silver betting the price will fall and margins rise, you're actually in better shape because the price is moving in your direction. You're not facing margin calls. Your counterparties are. So yes, mechanically, margin hikes benefit shorts and punish longs. That's not conspiracy. But here's where the argument falls apart. The CME isn't raising margins to help shorts. They're raising margins because their clearinghouse is exposed to counterparty risk. Let me explain the incentive structure. When you trade a futures contract, the exchange acts as the middleman. If you default on your position, the clearinghouse is on the hook. So when volatility spikes, when silver moves from $80 to $120 in 48 hours, the clearinghouse's risk explodes. They don't know which traders will default, so they demand more collateral from everyone. It's not personal, it's actuarial. Now, could the timing be better? Absolutely. Could exchanges implement dynamic margin requirements that adjust more gradually to avoid triggering cascades? Probably. But the idea that this is coordinated manipulation requires believing that the CME, JP Morgan, the Fed, and algorithmic trading firms are all working together to crush retail traders. That's not impossible, but it requires a level of coordination and secrecy that financial markets, famously chaotic and competitive, rarely demonstrate. The simpler explanation? Markets got over-leveraged. A policy shock, Warsh's nomination, created uncertainty. Algorithms front-ran headlines. The CME responded to spiking volatility by raising margins. Traders couldn't meet the calls. The cascade happened. No conspiracy required. Just incentives, leverage, and liquidity vanishing at the worst possible moment. So who actually wins and loses here? Let's be specific, because the costs aren't evenly distributed. Retail traders, the silver squeezers who believed they'd found the next short squeeze, got annihilated. Most leveraged accounts were wiped out entirely. The research notes that 99% of liquidations were long positions, meaning almost everyone betting on higher prices lost. These aren't hedge fund managers with diversified portfolios. These are people who saw a narrative, believed it, and committed capital they couldn't afford to lose. The psychological and financial damage is real. Institutional whales fared slightly better, but only slightly. One trader on Hyperliquid lost $18.13 million. That's institutional scale money, but even for professionals, that kind of loss isn't trivial. The whales who survived were the ones who either took profits early Thursday or had enough capital reserves to weather the margin calls. Conviction didn't save you. Liquidity did. Industrial buyers, companies that actually use silver for solar panels, AI chips, electronics, experienced chaos. The research describes a liquidity trap. They couldn't secure physical metal at predictable prices. Thursday, silver is $120, which is already too expensive for thin-margin manufacturers. Friday, it's $78, but the order books are in free fall. By the time spreads normalize, prices have moved again. For a manufacturer operating on quarterly contracts, that kind of volatility isn't just inconvenient. It makes planning impossible. Some likely delayed projects. Others may have locked in unfavorable hedges earlier in the week and are now stuck with above-market costs. The CME and COMEX, conversely, achieved exactly what they wanted: systemic stability. By hiking margins, they forced out weak hands before defaults could cascade through the clearinghouse. They avoided bad debt. From their perspective, this is success. The system didn't break. And then there's the Fed and Treasury. The wash rally, the dollar strengthening on expectations of tighter policy, benefits the U.S. in the short term. A stronger dollar makes imports cheaper, which helps control inflation. It also reasserts dollar dominance at a moment when China is trying to position the yuan as a reserve currency alternative. Trump's nomination of Warsh wasn't primarily about silver, but the downstream effects, capital flowing back into dollar-denominated assets, commodities repricing lower, serve U.S. policy goals. If you want to understand why this keeps happening, look at the Hunt brothers in 1980. Nelson Bunker Hunt and William Herbert Hunt tried to corner the silver market, accumulating over 100 million ounces. They drove the price from $6 to $50 per ounce in less than a year. The mechanics were similar. Buy physical silver, buy futures contracts, squeeze the shorts by demanding delivery of physical metal they didn't have. The exchanges responded by changing the rules. The COMEX implemented Silver Rule 7, which prohibited new long positions and allowed only liquidation. Margins were raised, credit was cut off. Silver collapsed from $50 to below $11 in 2 months. The Hunt brothers lost billions and eventually filed for bankruptcy. The parallel isn't exact. There's no single actor cornering the market today, but the mechanism is identical. Over-leveraged longs meet an exchange willing to change rules to preserve systemic stability. And every time, the longs call it manipulation. Every time, the exchange calls it risk management. Both are partially right. The lesson isn't that markets are rigged. It's that leverage amplifies both gains and losses. And when you're playing with borrowed money on an exchange, the exchange holds the kill switch. They can and will raise margins when volatility spikes. If you're not prepared for that, you're not trading. Here's what actually matters next. And it's not where silver trades tomorrow. It's whether this kind of liquidation spreads. Because silver wasn't the only asset trading on momentum and leverage. It was just the first to break. Think about what we learned this week. A 36% margin hike triggered $70 million in liquidations in 4 hours. An unclear Reuters headline caused algorithms to execute mass sell orders. A Fed chair nomination, not even a policy change, just a nomination, was enough to reverse a 2-year rally overnight. And assets marketed as hedges, as safe havens, fell faster than equities. Now ask yourself, what happens when this logic applies to crypto, which trades at 100 times leverage on offshore exchanges? What happens to AI stocks trading at valuations that assume infinite growth? What happens to real estate, to private equity, to all the illiquid assets that were revalued upward during a decade of zero interest rates? I don't know, and nobody does. But I know this. When even hedges behave like speculative trades, when conviction disappears the moment financing tightens, when liquidations happen faster than humans can react, that's not a sign the asset is broken. It's a sign the system is under stress. And stress, once it starts, rarely stays contained to a single market. Silver went from $120 to $78 in 24 hours. The squeeze met its match. What matters next is whether that match just got lit elsewhere, and we're all waiting to see where the fire spreads.